Welcome to another episode of Founders Insights. Today, we're at Best Ever Conference in Salt Lake City. It's always great to be back here every year to meet with some of our amazing investors and partners, as well as some new potential relationships. Really great time here, networking. Haven't really left the hotel, but we have had the chance to host some really fantastic dinners with some very valued relationships. So all in all, very productive trip. However, today was not the best day because I woke up and I saw that treasuries were up 20 basis points. That's not the way you want to start a day, but we move on. So today I want to talk about 1031 exchanges, and we have definitely talked about 1031 exchanges across our various platforms and channels and written articles about them. And if you are interested in learning more about doing a 1031 exchange with us at Lone Star Capital, we definitely invite you to reach out and we can share more information. We have a 1031 exchange guide that we share with our prospective 1031 exchange partners, and we're working on a more in-depth 1031 exchange ebook. But with that being said, just a quick high-level breakdown. 1031s, as I'm sure most of you know, is a tax-deferred exchange, which is a very favorable tax advantage of real estate, which allows you to sell a property and then exchange the proceeds of that sale into a new acquisition and defer 100% of the capital gains associated with the down leg transaction. This is a very popular tax strategy for long-term real estate investors. If you look at just a chart of somebody who is able to 1031 exchange from deal to deal, decade to decade, where they end up over a 30-year span versus somebody who is buying and selling, paying the tax, buying and selling, paying the tax, it's not even close. The compounding nature that you get from the tax efficiency of the 1031 exchange is just going to allow you to compound your wealth really dramatically. And that's just one of the reasons that we're so excited about it. But one thing that is really great is that we actually allow for 1031 exchanges into our deals, which is a really valuable asset for someone who is perhaps a tired landlord. If someone's going from active ownership of a real estate asset, let's say it is a rental property or a triple net lease type deal, and they want to move into a more passive form of ownership, we can actually effectuate that by bringing a tenancy in common structure into our deal and allow someone to 1031 exchange out of their perhaps wholly owned asset to now owning a portion of an asset with us in one of our large institutionally managed professional multifamily deals. This is really fantastic. It allows people the vehicle to get into one of our deals, enjoy the monthly cash flow and the hands-off nature associated and the white glove treatment associated with partnering with Lone Star Capital. So like I said, if you are interested in learning more about partnering with Lone Star Capital in a 1031 exchange, we definitely recommend you reach out to us to get involved. The earlier you get involved, the better, because there are some nuances associated with structuring the tenancy in common in order to bring a 1031 exchange investor into the org chart, get them recognized and underwritten by the lender, and then hash out all the legal and the nuances there. There's definitely a lot there, but we've done this many, many times. My business partner is a tax attorney. We have definitely seen it all at this point and feel very comfortable and confident in executing the transaction for you, the 1031 investor, which is extremely important because obviously there's a ton hanging in the balance when you are doing a 1031 exchange. You're not only risking investing in a good deal when you do a 1031 exchange, you're also risking the deferred taxes. Because if you are doing a 1031 exchange that you've rolled over perhaps multiple times, you have a huge backlog of deferred taxes. And if your 1031 exchange, this blows up, then you might be stuck paying back taxes associated with all the deferred gains from previous deals. And that's something that we don't take lightly and something we want to make sure to make you comfortable and be able to sleep well at night going through what is a stressful situation that is the 1031 exchange. Speaking of nuances associated with 1031 exchanges, one of the impetuses for this video actually was we were having a conversation at one of our company all-hand meetings, and we were discussing the peculiarities or the nuances associated with taxes for 1031 exchange investors. So the nuance when you do a tenancy in common is that a 1031 exchange investor in our deals is a tenant in common with us in the deal. And when I say us, I'm referring to our newly formed single purpose entity, which is usually just an an LLC or an LP. And that is our, call it our syndication or our JV entity, which pulls in investor capital, and then we have a manager entity that manages that entity. And that is our typical simple org chart. However, with a tenancy in common to bring the 1031, you now have co-borrowers, co-owners in the tenancy in common structure to facilitate the 1031 exchange. The reason for this is you can't 1031 exchange into a syndication, because a syndication, when you own a share of a syndication, you're just really owning a share of an LLC. So, or you basically own a partnership interest, and a partnership interest is not real estate. And when you do a 1031 exchange, it's a like-kind exchange of real property. So you have to own real property, which is why we facilitate it through the tenancy in common. So when we have 1031 exchanges, they come and invest and own the real estate directly side by side with our LP or our LLC. This can create confusion when it comes to tax time, because a 1031 exchange investor might be anticipating a K1 just like they would if they were a partner in the LP or the LLC, like all the other investors in the deal. However, there is no K1 for a 1031 exchange investor because they don't own a share of the partnership, and a K1 is a reflection of a partner's interest in a partnership. So there is no K1 for the 1031 exchange investor. So what is there for the 1031 exchange investor when it comes to taxes? Well, we provide a full year-end financial package for the 1031 exchange investor, which outlines the schedule as far as income and expenses, losses and everything, and basis, depreciation, and we provide that to the 1031 exchange investor, and then it's up to them to work with their CPA to actually have those income and losses flow to their either their 1040 if they own that tenancy in common of that real estate deal. If it's owned just in their personal name, it would just flow to their personal tax return. Often these 1031 exchanges are owned in trusts or LLCs or a partnership, which then basically, not to get too far into the legal and tax side here, but the property level financials associated with that partial ownership, tenancy in common, would, let's say it's owned in a partnership, would flow to that partnership, and then that partnership would produce K1s, and then the members or the partners of that partnership would get their K1 for that entity. So there is a little bit more work, a little bit more handholding when it comes to tax time for 1031 exchanges, which is why we wanted to make this video, because it is tax time right now. We're dealing with some of these issues right now as we've been providing K1s as well as the year-end financials to our 1031 exchange partners. Hope you found this interesting. There's a lot more where this came from. 1031 exchanges can be very complicated. We worked very hard to make it simple for you. So again, one last time, if you'd like to learn more about partnering with us in a 1031 exchange or just simply as a capital allocator or investor, please reach out to us. You can just reach out to me directly, find information at the bottom of this video, or you can head over to our website, lscre.com.